The second paycheck had already been woven into the household before anyone noticed it had stopped feeling optional. By the time the promotion letter arrived, the mortgage application had already been submitted with both salaries listed in bold on the final page. It wasn't framed as dependence, it was presented as qualification. The loan officer had run the numbers using combined gross income, averaged bonuses, and projected stability based on two established careers in adjacent industries. The approval amount reflected that calculation precisely. The house that followed fit neatly inside it. At closing, nothing felt fragile. Two direct deposits, two employer sponsored retirement plans, two health insurance options. It read like redundancy, protection through partnership. The language of financial security had surrounded the decision from every angle. The home itself wasn't extravagant. Four bedrooms in a developing suburb outside a mid sized American city. Commute times under 40 minutes for both. Property taxes consistent with the county average. A fixed rate mortgage locked in during a stable interest cycle. The payment, on paper, stayed within conventional debt to income guidelines. No stretching beyond what underwriting software permitted. Furniture arrived gradually. A sectional financed at 0% for 18 months. A dining table bought outright after a year-end bonus. Appliances replaced in sequence rather than all at once. The household grew into its square footage the way most American families do, incrementally, responsibly. Two incomes made the math comfortable. Childcare entered later. The first year was managed through alternating schedules and a patchwork of family help. Eventually, a licensed daycare facility became necessary. Tuition rivaled a second mortgage, but both salaries covered it without immediate strain. Employer health plans shifted to a family tier. Flexible spending accounts were elected. Dependent care contributions were maximized. The second paycheck continued to operate as reinforcement. It absorbed the irregular costs. Summer camps. Dental work not fully covered. A transmission repair that arrived without warning. None of it destabilized the checking account. The buffer existed because two pay cycles replenished it every month. Over time, fixed expenses matured alongside income. Property taxes adjusted upward as the neighborhood developed. Home insurance premiums climbed quietly each renewal cycle. Utilities rose in proportion to usage and rate increases. The mortgage remained fixed, but the cost of occupying the property did not. Salary increases arrived too, but they followed corporate structures. Annual reviews, modest percentage bumps. Occasionally, a lateral move that preserved income but expanded responsibilities. Retirement contributions were increased gradually. 10% became 12. Employer matches accumulated without much reflection. There was no single moment when the second income became non-negotiable. It happened through accumulation. A larger SUV replaced the sedan after the second child. The purchase decision used household income projections over 5 years. College savings accounts were opened with automatic monthly transfers. Life insurance policies were recalibrated to account for combined earning potential rather than individual necessity. The household spreadsheet, updated quarterly, showed stability. Net worth trended upward, slowly but reliably. Home equity, built as principal, declined. Retirement balances fluctuated with market cycles but generally advanced. Credit scores remained strong. Then one employer restructured. It wasn't sudden in the sense of collapse. There were memos, a reorganization, departments consolidated, roles redefined. The severance package was calculated based on tenure and position. Health coverage extended temporarily under federal continuation provisions at a cost far higher than the payroll deduction that had once made it feel routine. The first month without the second paycheck did not produce immediate alarm. Savings covered the gap. Severance softened the transition. The assumption was that comparable employment would follow within a quarter or two. After all, the resume reflected stability. Performance reviews had been positive. The industry remained viable. But the job market did not respond to household obligations. Interviews stretched across months. Compensation bands for open roles were narrower than previous earnings. Remote positions attracted national competition. Offers, when they arrived, came with adjustments: lower base salary, reduced bonus structure, fewer benefits. Meanwhile, the household continued operating at a cost structure built on two incomes. The mortgage payments withdrew automatically. Daycare tuition remained unchanged. Insurance premiums did not scale down because one salary disappeared. Property taxes arrived as scheduled. The SUV loan amortized monthly. Grocery bills reflected inflation more than employment status. The checking account began to show the math more clearly than the spreadsheet had. Retirement contributions were paused first. Then, college savings transfers. Health coverage shifted to the remaining employer's plan, which carried higher deductibles and narrower networks. The emergency fund, once described as 6 months of expenses, recalculated itself under the new single income reality and felt shorter. No one described it as crisis. It was adaptation. Responsible households adjust. Yet the realization surfaced gradually. The life constructed over a decade had been calibrated precisely to the existence of two stable paychecks, not aspirationally, structurally. The house could not be refinanced into lower payments without resetting to long term. Selling would introduce transaction costs and disrupt school zoning. Daycare contracts required notice and deposits elsewhere if alternatives were sought. Health insurance choices were bounded by employer offerings and federal regulations. The financial architecture had hardened. A new job eventually materialized. It paid less. Benefits were adequate but not generous. Commute time increased. The second income returned, but in altered form. Combined earnings no longer matched the previous peak. Yet, fixed expenses had not retreated in proportion. The household adjusted again. Vacations shortened. Home improvement plans deferred. Discretionary spending tightened around the edges without formal declaration. Years passed. Promotions resumed. Income recovered incrementally. The children aged out of daycare, replaced by extracurricular costs of a different category. College savings resumed, but at a more conservative rate. Retirement contributions increased again, though the loss compounding from paused years lingered invisibly in future projections. The structural dependence remained, even as the immediate memory of unemployment softened. Later, another shift occurred, this time voluntary. One partner reduced hours to manage elder care responsibilities as aging parents required supervision. The decision felt humane, necessary, aligned with family values. It also reduced household income by a measurable percentage. The mortgage was still present. The SUV loan had been replaced by another vehicle, purchased during a period of renewed dual income confidence. Insurance premiums reflected both inflation and expanded coverage needs. Property taxes continued their upward trajectory in a growing district. What had once seemed like redundancy, two careers progressing in parallel, revealed itself as a foundation upon which everything else rested. There had been no extravagance, no speculative investments, no consumer excess beyond mainstream American norms. The household had operated within conventional guidelines, followed employer advice on retirement contributions, maintained adequate insurance, and avoided high interest debt. Yet the cost structure was calibrated to the combined earning capacity of two adults working consistently across decades. In conversations with peers, similar patterns emerged. Two-income households qualified for larger mortgages than single-income households with identical individual salaries. Lenders evaluated aggregate income. Real estate markets priced accordingly. School districts, property taxes, and neighborhood amenities followed comparable logic. The housing itself did not demand two incomes out of extravagance. It demanded them because underwriting systems had already assumed them. Over time, the second paycheck stopped feeling like acceleration and began functioning as equilibrium. Removing it did not create luxury reduction. It created imbalance. Retirement projections later incorporated the interruption years. Financial planning software displayed scenarios under varying assumptions. Working longer restored certain metrics. Increasing contribution rates partially compensated. Market returns filled some gaps unpredictably. The couple did not speak of regret. They spoke of sequence. Of how each decision had been reasonable in isolation. Of how qualification thresholds subtly shaped lifestyle baselines. Of how the phrase, "we can afford it," had always been technically correct, given the data at the time. They also recognized that affordability had been defined in terms of current income stability rather than long term flexibility. The children eventually left for college. Tuition bills replaced daycare payments. One car aged out without replacement. The home remained, its value appreciated, its mortgage balance lower but not extinguished. Dual income persisted into midlife not because both careers were equally fulfilling at every stage, but because the household architecture expected it. Health insurance, retirement accumulation, mortgage amortization, tax brackets, each calculation referenced combined earnings. When one partner briefly considered stepping away entirely, the numbers were run again. Health insurance premiums in the individual marketplace, loss of employer retirement match, the shift from two social security earnings records to one, the tax implications of reduced adjusted gross income, nothing was impossible, nothing catastrophic. The model simply revealed how thoroughly two incomes had been integrated into every projection. In their early 40s, they had believed the second paycheck expanded choice. In their 50s, it felt more like maintenance. There were still moments of stability. Promotions regained some lost ground. Home equity grew substantially as property values increased across the region. Retirement balances, after market recoveries, surpassed prior peaks. On paper, the household looked secure. But the dependency remained embedded. The standard of living, though modest by national standards, required continuous participation from both earners to sustain its current form without erosion. Neighbors experienced similar arcs. Dual income households anchored subdivisions built during periods of low interest rates and accessible credit. School fundraising reflected combined professional salaries. Local businesses priced services accordingly. The regional economy itself assumed two working adults per household in its design. Looking back, there had been no singular miscalculation, only a gradual alignment between what lenders permitted, what employers paid, and what communities normalized. The second paycheck had never been labeled essential at the beginning. It became essential through repetition. Even as retirement approached on a distant horizon, conversations circled around timing. Could one retire earlier than the other? What would health coverage look like before Medicare eligibility? How would pension accruals interact with Social Security claiming strategies? The models displayed multiple scenarios. Each one recalibrated expenses against expected income streams. Each one implicitly referenced the historical reliance on two consistent careers. The household had built equity, accumulated savings, and avoided catastrophic debt. It had functioned responsibly within American financial systems. And still, the realization lingered without dramatic framing. The life constructed across 25 years had been engineered for dual income continuity. Not as extravagance, not as ambition, as baseline. The second paycheck had stopped feeling like additional security long ago. It had become the structure itself.